Welcome to the research desk.
Glad to be here.
So I want you to imagine for a second that you're standing inside a massive, just beautifully constructed house, and you look around and you feel incredibly secure.
Right. Because of the materials?
Exactly. You know this house was built with a diverse mix of materials. You've got a reinforced steel frame. You have solid brick exterior walls, maybe some flexible wooden joists, and, shatter-resistant glass.
It feels bulletproof.
Right. In your mind, you are entirely protected against any single point of failure. Like a fire might consume the wood, but the brick is going to stand. An earthquake might crack the glass, but the steel holds. And this is basically the foundational premise of modern asset allocation.
The classic diversified portfolio.
Precisely. It's this remarkably simple, incredibly comfortable concept. As an investor, you just assemble this basket of geographically distinct, sectorally diverse assets. You hold domestic equities, international bonds, commodities maybe, some real estate.
And you assume that structural variety creates a permanent safety net.
Exactly. You assume you're safe. But what if you found out that every single one of those materials, the steel, the brick, the wood, was secretly resting on one hidden microscopic fault line? In quantitative finance, we call that hidden architecture a star graph.
Which is a network with a single central hub.
Right. And when that hub fails, the steel, the brick, and the wood, well, they don't behave like diverse materials anymore. Every spoke in the wheel fails simultaneously. The diversification you thought you had it vanishes precisely when you need it most.
Because standard mathematical models, like standard correlation matrices, are fundamentally blind to this hidden wiring. They only measure linear, average behavior over really long periods of time.
Exactly. Which is why today we are debating the only mathematical framework capable of revealing that actual topology of systemic risk, Vine Copulas. I'll be arguing that Vine Copulas provide a precise empirical map of the Contagion Highway. They let us identify exact sequences, time lags, and structural hubs of systemic risk.
And I will be taking the opposing view. Because while I agree that vines can map the anatomy of the last crisis beautifully, financial networks are fluid. The topology is unstable. So the danger lies in assuming that the tree structure mapping the crash will equal the tree structure mapping the recovery.
Right, so you're saying the map is backward-looking.
Absolutely backward-looking. Assuming a historical map of past contagion roads can predict new ones it's a massive blind spot. But to be fair to your side, we should probably establish why standard correlation fails so badly here. It comes down to what we call the curse of dimensionality.
Right, the curse of dimensionality. When you evaluate a portfolio of just, say, 10 assets, you aren't just looking at 10 individual risk profiles, you are looking at 45 unique pairs. Because the number of pairwise relationships, it scales quadratically.
And standard quantitative models try to force a single high-dimensional structure onto all of those pairs at once, like a multivariate Gaussian distribution or, a single student T copula, which is mathematically intractable, but more importantly, it's statistically dangerous. It essentially forces the model to assume that the relationship between, say, U.S. equities and U.S. Treasury bonds behaves exactly the same way as the relationship between European bank stocks and Asian industrial commodities.
Which we know empirically is just not true. Vine copulas dismantle this entirely by breaking down that high-dimensional joint distribution into a cascading tree of bivariant pair copulas. They strip away the noise.
Yeah, they break it down into pairs.
Right, which is why I argue they are the ultimate tool for this. By decomposing market risk into these structural trees, we aren't relying on simple averages anymore. We can identify the exact chronological sequences.
The time lags.
The time lags, exactly. The specific delay between one market crashing and another reacting. We can take the chaotic, seemingly simultaneous noise of a global market crash and turn it into a readable topology.
And I will readily agree that high-dimensional dependence is infinitely more complex than simple pairwise relationships. A static correlation matrix is dangerously reductive. But I strongly caution against treating the maps generated by fine copulas as like permanent geography.
But they give us directional arrows of contagion. That's a massive upgrade from a correlation matrix.
It is an upgrade, but the map changes. Financial contagion is dynamic. But before we get into the instability of the maps, let's build that rigorous foundation. We have to view contagion as a network propagation problem.
Like epidemiology?
Exactly, like epidemiology. In epidemiology, knowing the R naught, the basic reproduction number of a virus, that's completely insufficient if you actually want to stop an outbreak in a local community.
Right, you need to know exactly who infected whom.
Yes, in what specific order and through which specific social nodes. The financial equivalent of an R naught is the Pearson correlation coefficient. And it fails us for two very distinct reasons.
Well, first, it assumes symmetric relationships, meaning it assumes two assets move together the same way on the way up as they do on the way down.
Right. And second, it assumes linear relationships. It completely misses the exponential acceleration that happens during a panic.
Standard models are forced into this category error by that curse of dimensionality we just mentioned. If we look at those 45 unique pairs in a 10-asset portfolio, we know from decades of data that the tail dependencies are completely heterogeneous.
Some crash together but rally independently.
Exactly. Others rally together during bull markets but crash independently. So forcing one mathematical family onto all 45 pairs, well, it obscures the actual mechanisms of danger.
I think it's crucial here to clearly define what we mean by tail dependence and copulas before we get too deep into the architecture. If someone listening isn't familiar with Sklar's theorem, they might be wondering how we can even separate the behavior of an individual asset from its relationship with the broader market.
That's a good point. So back in 1959, Abe Sklar proved that any multivariate joint distribution can be fundamentally split into two distinct parts.
Right, the marginals and the copula.
Yes. The marginal distributions, which describe how each asset behaves on its own, and the copula, which describes the pure dependence structure between them.
I like to think of the marginal distribution as a person's individual personality. And the copula is, well, it's the dynamic of their marriage.
That's a great analogy. Standard correlation just blends the two together, but a copula extracts the pure relationship. And when we talk about tail dependence, we are focusing purely on the extreme edges of that relationship.
The absolute worst-case scenarios.
Exactly. We're asking a highly specific question. If asset A is experiencing an event in the absolute bottom 1 percentile of its historical outcomes, what is the mathematical probability that asset B is simultaneously experiencing an event in its bottom 1 percentile?
Standard linear correlation tells you how they behave on an average Tuesday. Tail dependence tells you what happens on Black Monday.
Precisely. And that's where the framework developed by Tim Bedford and Roger Cook back in the early 2000s comes in, and Kirsty Oss and her colleagues later operationalized it. They took Sklar's theorem and scaled it.
Because trying to find one massive copula for 20 assets is impossible.
Right. So instead, their framework decomposes the entire network into a hierarchy of simple two-variable copulas, pair copulas. And by building these pairs into a structured tree, we can categorize networks into distinct topologies.
Like the C-vine.
Yeah, the canonical vine, meaning the entire network revolves around a single massive hub. Or we might identify a D-vine, a drawable vine, which means contagion propagates sequentially down a long chain like falling dominoes.
Or an R-vine, a regular vine which is just a chaotic, interconnected mesh without a clear center.
Right. And by mathematically identifying this underlying structure using historical data, we can spot the one-way downhill roads before the traffic actually arrives. We find the hidden star graph.
I mean, the mathematical elegance of the Bedford, Cook, and Ayas framework is undisputed. Trading the curse of dimensionality for the blessing of decomposition, that was a watershed moment in quantitative finance.
Absolutely.
But, and this is a massive but, we must confront the absolute reality of the combinatorial explosion.
Well, sure, the math gets heavy.
Heavy is an understatement. When we scale this theoretical model up from, a toy example of 4 or 5 assets to a realistic institutional portfolio of 20 assets, we aren't looking at 45 pairs anymore. To find the optimal R-vine tree structure for 20 nodes, the algorithm has to search through roughly 10 to the power of 17 possible R-vine tree configurations.
It's a huge number.
10 to the 17th power is incomprehensible. It is structurally impossible for any computer to test every single one of those combinations. So what do practitioners do? They rely on heuristic, sequential, greedy algorithms.
Which simply means the algorithm builds the tree step by step. It makes the locally optimal choice at each individual junction rather than trying to solve the entire global puzzle at once.
Precisely. It looks at the strongest pairwise connection, locks it in, and moves to the next. The problem with greedy algorithms is they do not guarantee a globally optimal map. They guarantee a mathematically convenient one.
But it's an empirically useful approximation.
It's an approximation mapping a topology that is inherently unstable and deeply regime-dependent. My primary assertion today is that the most vital insight we gain from Vine Copulas isn't seeing the historical contagion chain with perfect hindsight. It's the realization that structural network breaks happen instantaneously.
You're talking about the shift from crash to recovery.
Yes, the topological map of a market crash is fundamentally different from the topological map of the subsequent market recovery. Assuming symmetric propagation, assuming the way down is exactly the way up, is the ultimate failure of risk management.
Okay, well, to determine if these maps are just historical curiosities or genuinely predictive models, we need to ground this theory in empirical reality. Let's look at the ultimate proof of concept for the sequential chain structure, the D-Vine.
You're going to bring up 2008, aren't you?
Of course I am. The 2008 global financial crisis. It is constantly described in the financial press and even honestly in some academic retrospectives as this simultaneous global collapse. It's treated as an event where all correlations just suddenly went to one.
Which is a myth.
A complete myth. The Divine Copula framework reveals it was anything but simultaneous. It was a precise, quantifiable cascade. If we construct a vine using daily returns from 2006 through 2009 across key indices, U.S. subprime mortgages, U.S. bank equities, European banks, Asian exporters, and global commodity futures, the algorithm consistently selects a D-Vine topology.
It maps the domino effect perfectly.
Exactly. A sequential domino effect. And the root node of this entire structure, which is objectively confirmed by using maximum spanning tree selection based on Kendall's tau rank correlation, is the U.S. subprime market.
Let's actually pause on Kendall's tau for a second, because I think it highlights exactly why this method cuts through the noise of traditional metrics.
Go ahead.
If someone is familiar with Pearson correlation, they know it measures the linear trajectory of two variables. But Pearson is incredibly sensitive to massive outliers. If the market has one catastrophic drop, the Pearson correlation gets skewed dramatically by the magnitude of that single day.
Right, it throws the whole average off. Exactly. Kendall's tau doesn't care about the magnitude. It cares about the rank order. It essentially asks, if today is the absolute worst day in the history of the subprime index, is it also the absolute worst day in the history of the U.S. banking index?
If it's the fifth worst for one, is it the fifth worst for the other?
Right.
By focusing on the sorting of extremes rather than the average magnitudes, Kendall's tau provides a much cleaner signal of true dependence. And the exact sequential hops identified by this metric are where the pair copulas really show their descriptive power.
So let's trace that highway hop by hop. Let's observe exactly how the network transmitted the shock. Hop 1 is the connection from U.S. subprime mortgages to U.S. banks.
The epicenter.
The epicenter. The Vine captures a massive surge in tail dependence here, shifting from a calm period baseline of 0.15 all the way up to 0.65.
And the time lag calculated between these two nodes is 0 days.
A contemporaneous shock.
Contemporaneous, exactly. And crucially, the sequential algorithm selects a Clayton copula with a parameter of 4.2.
Now, for someone wondering what a parameter of 4.2 looks like in the real world.
Yeah, let me explain that. The Clayton copula specifically models asymmetric lower tail dependence. Think of it like a black hole that only exists at the bottom of the market.
Right. When prices are rising or stable, the Clayton copula asserts very little gravitational pull. The assets can drift apart. But when prices collapse, the gravity becomes absolute. Everything is sucked into the center together. So the selection of a Clayton copula with a parameter this high activates exclusively during crashes. It statistically confirms that this first hop was a one-way downhill road.
And then we reach the second hop, which is the exact moment the localized mortgage issue metastasized and the systemic nature of the crisis truly internationalized. The contagion moves from U.S. banks to European banks.
Right across the Atlantic.
Yes. The lower tail dependence registers at 0.52, but unlike the immediate 0-day transmission of the first hop, The vine detects a measurable time lag of 3 to 5 trading days.
And that's not just abstract math.
No, it's not. This edge activated on a very specific historical date, August 9, 2007. That is the exact day BNP Paribas froze 3 of its investment funds, citing a complete evaporation of liquidity in the U.S. asset-backed securities market.
See, if you are using a standard correlation matrix, you take the data from 2007 and 2008, you average it out over 252 trading days, and you get a single number.
A single, useless number.
Right, it's like taking a long exposure photograph of a busy intersection. All you see is a blur of headlights. You cannot distinguish the individual vehicles or the sequence of the accident. Because standard correlation averages out those 252 days, it completely swallows that crucial 3 to 5 day lag.
It blends the initial shock and the delayed reaction into one simultaneous blur.
Exactly. The Vine copula operates like a high-speed camera, capturing the transmission frame by frame. Following that European bank shock, the Vine maps the transmission out of the financial sector and into the real economy. HOP3 links European banks to Asian exporters.
And this edge carries a tail dependence of 0.38, with a remarkably long time lag of 7 to 10 days.
Because of the trade finance freeze.
Right. That specific lag represents the freeze in global trade finance. Asian exporters relied heavily on letters of credit from major European and American institutions. When interbank lending froze in Europe, the credit lines that physically moved cargo ships across the Pacific were severed.
The physical supply chains kept moving for about a week on just, well, existing momentum, before the lack of fresh financing forced the dead halt.
Exactly.
And finally, HOP4 completes the entire D-Vine chain. It moves from those Asian exporters into global commodities. The lower tail dependence drops slightly to 0.29, with the lag extending out to 10 to 14 days.
Which represents actual physical demand destruction.
Right. Factories in Asia slowed down, which meant they stopped ordering raw materials, which eventually drove the price of copper, oil, and iron ore into the ground. A D-Vine estimated purely on pre-crisis data identified this exact sequence: banking first, real economy second, commodities last, months before Lehman Brothers filed for bankruptcy.
It predicted the shape of the pileup before the cars collided.
Yes, exactly.
I mean, that is a compelling narrative, and I concede that the 2008 D-Vine is a masterpiece of forensic financial pathology. But forensic is the operative word there.
You're saying it's an autopsy report?
It is an autopsy report. We need to explore a broader metaphor to really grasp the danger of relying on this map for future risk. Think of global financial flows as a vast river delta. Water enters through a single main channel, the root node, and branches outward into a network of smaller distributaries.
Okay, I'm with you.
During a catastrophic flood, which represents our market crisis state, the main channel overwhelms its banks. It activates secondary, hidden channels that are completely dry and invisible during normal weather conditions.
Right. The lower tail dependence kicking in.
Yes. Now, a calm weather correlation survey never maps those overflow channels because the water has never been there. The 2008 global financial crisis was essentially the River Nile. It behaved perfectly as a divine. It was a single, predictable thread, winding sequentially through specific floodplains, moving methodically from mortgages to banks to exporters.
It flooded exactly the way the historical topography suggested it would.
Exactly. But what if the next crisis is not the Nile? What if the next crisis behaves like an R-vine, functioning more like the chaotic, sprawling mesh of the Amazon River?
Where the tributaries flow into each other.
Right. In the Amazon basin, during extreme weather events, the sheer volume of localized rainfall can actually force tributaries to flow backward. The flow reverses direction. Or what if the next crisis is a sea vine, acting like the Mississippi Delta, flooding dozens of different distributaries simultaneously from a single centralized hub?
I see the point you're making.
The map you are relying on is fundamentally backwards looking. You map the Nile flawlessly. You know exactly how many days it takes for the water to reach the sea. But that map is entirely useless when you find yourself standing on the banks of the Amazon.
Okay, I accept the river delta analogy. But I would argue that while the specific topography might vary from crisis to crisis, the underlying mechanics of mapping the water flow remain robust. If 2008 proves that Vine Copulas can successfully map a sequential, domino-style chain, we are obligated to ask how the framework handles a radically different topology.
A simultaneous shock.
Exactly. Specifically, how does it process a truly simultaneous exogenous global shock? This brings us to the ultimate stress test of the framework, March 2020, and the outbreak of the COVID-19 pandemic.
March 2020 is the perfect laboratory for this debate. It proved my central thesis regarding topological instability far better than 2008 does.
How so?
Because the network fundamentally rewired itself in real time. If we look at the initial crash trajectory starting in early 2020, the Vine copula maps a very clear propagation path. The algorithm identifies the root node unequivocally as China.
Right, the epicenter of the outbreak.
Yes, the contagion flows outward from China to the broader Asia-Pacific region, then to Europe, then across the Atlantic to the United States, and finally into the global oil markets. Wuhan initiated its strict lockdown procedures on January 23rd, but the S&P 500 in the U.S. didn't reach its peak until February 19th.
That is a 27-day lag.
A 27-day lag. Just as in 2008, standard correlation blended that months-long delay into a single block of volatility, the Vine's tree structure, however, successfully captured it as a distinct three-hop propagation chain.
Remarkably, just like in 2008, the pair Copulas selected along the specific crash vine were almost uniformly Clayton.
Yes, they exhibited lower tail dependence coefficients exceeding 0.55 at every single hop. As the shock crossed borders, the gravitational pull of that black hole amplified.
So the initial shock wave behaved like a classic contagion event. It originated from a physical disruption and spread outward. But the mathematical revelation of this era is exactly what you just alluded to. The network did not stay static.
It did not. And this is the core insight of the COVID-19 financial event, something every single risk manager needs to internalize. The contagion vine does not equal the recovery vine.
Right, the topology flipped.
When the Federal Reserve announced unprecedented, unlimited quantitative easing on March 23, 2020, the underlying topology experienced a violent, instantaneous structural break. The United States market instantly usurped China to become the new root node of the entire global network.
The direction of the water in our river delta entirely reversed.
Completely reversed. The recovery propagation flipped the script. The capital flow moved forcefully from the U.S. to Europe, back to Asia, down into emerging markets, and finally lifting oil. And the mathematical models reflected this shift perfectly.
Because the Clayton Copulas disappeared.
Exactly. The Clayton Copulas, which captures shared crashes and lower tail dependence, were completely wiped off the board. They were entirely replaced by Gumbel Copulas.
And for the listener, let's define the Gumbel copula to contrast it with the Clayton. If Clayton is a black hole pulling everything down together, the Gumbel copula is a hot air balloon.
A great visual.
It specifically models upper tail dependence. It captures shared rallies. It basically suggests that when the central hub is rising rapidly, the connected spokes will be pulled upward with it, but they aren't necessarily tethered together on the way down.
Exactly. The Clayton copulas vanished, and the Gumbel copulas took over the architecture. The structural insight here is profound. The fundamental shock epicenter was undeniably China, but the financial policy epicenter was United States.
Which proves your point about asymmetry.
It does. Any institutional risk model, any static correlation matrix, or any rudimentary copula model that assumed symmetric propagation, that naively assumed the network architecture of the crash would perfectly mirror the recovery, mispriced the rebound as severely as it mispriced the initial collapse.
If you assumed the map was permanent, you were looking at the Nile while drowning in the Amazon.
Exactly.
But see, this asymmetric dynamic is not merely academic trivia. It translates directly into actionable portfolio construction and real-world hedging strategies. We can look at the very recent 2025 paper published by He, Wang, and Zhu regarding Sino-US financial contagion.
The Sino-US study. That's a great application.
Right. They applied this exact R-Vine framework to modern data and found a profound, quantifiable asymmetry between the two largest economies in the world. The lower tail dependence flowing from the United States to China registers at a highly significant 0.48.
Which is massive for two distinct economies.
Huge! It means that when the U.S. market suffers a severe crash, the probability that the Chinese market gets dragged down into a crash alongside it is incredibly substantial. The contagion arrow from west to east is thick and heavy.
But the reverse is not true.
Not at all. They measured the exact reverse path, the lower tail dependence flowing from a shock originating in China to the United States. That coefficient is only 0.19.
So contagion from west to east is roughly 2.5 times stronger than contagion from east to west.
Yes, and for an institutional allocator managing a sovereign wealth fund or a massive pension, this dictates billions of dollars in real capital flow. Hedging against a U.S. market crash requires securing derivative instruments entirely outside the reach of the global equity vine.
Because the U.S. pulls everything down with it.
Right. You need volatility products, or physical gold, or deep out-of-the-money put options, because the downward gravitational pull of the U.S. hub will drag almost every other equity market down with it. A Clayton Copula of 0.48 leaves no place to hide.
But hedging a China crash is totally different.
Exactly. Conversely, hedging a localized China crash requires almost no structural intervention if your portfolio is overwhelmingly dominated by U.S. market exposure, because the contagion arrow simply does not point in that direction with enough force to matter. Vine Copulas give us those arrows. They tell you exactly which way the traffic is flowing.
They do give us the arrows in liquid financial markets, where data is abundant and priced to the millisecond. But we must interrogate how reliable those arrows are when we step outside of pure financial asset pricing.
You want to talk about physical networks?
I do. If we are claiming this is a superior model of reality, we need to apply this mathematics to physical networks, to the real economy.
I completely agree. To prove that the underlying mathematics of Vine Copulas constitute a universal law of networks, rather than just a quirk of high-frequency financial market data, we should examine a physical business application.
Let's use the franchise example.
Perfect. Consider a corporate management team overseeing a 50-location retail franchise network spread across multiple states. Management inherently understands the basic pairwise dynamics at play here.
Right. They know that two retail locations situated within the same local zip code will likely cannibalize each other's sales.
Displaying negative dependence, exactly. Conversely, locations distributed across the same broad economic region will share exposure to regional macroeconomic trends, displaying positive dependence.
Makes sense.
So, we want to run a systemic stress test on this physical network. We ask the model a highly specific question. If the flagship location drops 50% in revenue due to a localized issue, what is the conditional probability that 10 or more locations simultaneously drop 30% in revenue?
Now, if that corporate management team relies on a standard Gaussian model, assuming normal distribution and linear correlation, which is exactly what most off-the-shelf enterprise risk software does, the algorithm outputs a probability of 0.3%.
A fraction of a percent.
Right. It categorizes the event of a cascading 10-store failure as a highly improbable, totally manageable local downturn. It basically tells the executive board that the flagship store's issues are isolated.
But when we take the exact same 3 years of monthly revenue data across those 50 locations and fit an R-vine to it, specifically allowing the algorithm to utilize Clayton lower-tail copulas to accurately capture extreme downside events, the output changes drastically.
How drastically?
The conditional probability of that cascading failure jumps from 0.3% to 8.2%.
That is a difference of a factor of 27.
A factor of 27, yes. It shifts the scenario entirely. It moves from a manageable, localized downturn that you can just ignore to an existential, systemic failure that requires immediate intervention.
It's absolutely critical for the listener to unpack exactly why that massive mathematical divergence occurs. It comes back to the core assumptions of the models.
The Gaussian assumptions versus reality.
Exactly. The Gaussian model fundamentally assumes that extreme events are independent. It assumes the statistical tails are thin. It looks at the average correlation between stores, which might be very low, and assumes that low correlation holds during a crisis.
Which it never does.
Never. The Vine algorithm, however, drops the blindfold. It reveals the hidden architecture of the franchise. It proves mathematically that the network is not locally correlated in a gentle, distributed, diversified way.
It is a star graph.
It is a star graph. And crucially, when the algorithm builds the tree,
It frequently reveals that the true root node of this star graph is actually not the largest flagship location by gross revenue.
Oh, right, it's often a hidden hub.
The root node, the actual center of gravity for the network, is often a medium-sized location situated in a regional economic hub. It might be a city whose local employment data systematically leads the rest of the network by 2 months.
And when that specific hidden hub declines, the Clayton Copulas activate.
Yes, they drag the satellite locations down with it, demonstrating extreme lower tail dependence. And this is the vital asymmetry. They don't share the upside. There is near zero upper tail dependence. If the hub booms, the satellites see a marginal lift. If the hub collapses, the satellites are wiped out.
This specific dynamic brings us to a point of absolute convergence between our respective positions, I think.
I think so too.
Whether we are discussing a physical 50-location franchise or a multi-billion-dollar institutional portfolio of sovereign bonds and global equities, true diversifiers are not assets that simply display low pairwise correlation over a smooth 10-year average.
No, true diversifiers are conditional firebreaks.
Conditional firebreaks. They are specific assets or specific geographic locations whose connection to the rest of the network completely vanishes once you condition on the state of the central hub.
When a corporation is deciding where to site a new franchise location, or when a portfolio manager is deciding whether to buy a new stock, the objective should not be to simply add another node to the network to reduce average volatility.
The objective must be to actively break vine chains.
Exactly. You must systematically search for the nodes that demonstrably do not connect to the hidden hub during extreme lower tail events.
Which is what the Vine Copula framework lets you do.
I agree entirely on the conceptual importance of conditional firebreaks. Finding them and verifying their structural integrity is the holy grail of modern risk management.
But
we must transition away from the theoretical elegance of these models and confront the practical, operational limitations of this framework. Can this theoretical architecture actually be traded? Or is the combinatorial complexity we discussed earlier a fatal structural flaw?
I wouldn't call it fatal.
I must present the bear case forcefully here. We discuss the combinatorial explosion, searching through 10 to the power of 17 possible tree structures for a modest 20-asset portfolio. That search is not a mathematically pure exercise resulting in a definitive truth.
No, it's a heuristic approximation.
Yes, a heuristic approximation. You are fundamentally building trees on top of trees on top of trees. The data for the first layer is real, observed market returns. But each pair copula, deeper in the vine architecture, in tree 3, tree 4, tree 5, is estimated using pseudo-observations.
Pseudo-observations which are derived from the trees above them.
Exactly. These pseudo-observations are themselves estimated quantities, derived mathematically from the copulas in the trees above them. Statistical estimation errors propagate down the vine exactly like rounding errors, cascading through a long, complex chain of calculations.
The error bars get wider.
Dangerously wide. By the time you reach the 4th or 5th tree in the structure, your statistical confidence intervals are dangerously wide. The economic interpretation of those deep, hidden connections becomes utterly fragile, almost meaningless.
I can see that the deeper trees are noisy.
But wait, furthermore, financial innovation constantly creates entirely new contagion paths that historical vines have never witnessed and cannot possibly model.
You mean unprecedented market events?
Exactly. Consider the catastrophic 2022 collapse of the Terra Luna cryptocurrency ecosystem. The contagion propagated rapidly from an algorithmic stablecoin that lost its peg into a decentralized lending protocol called Anchor, which then bankrupted a centralized crypto hedge fund called Three Arrows Capital, which subsequently triggered a run on a centralized crypto lender called Celsius, finally bleeding into traditional offshore hedge funds.
That was a wild sequence.
It was. And no Arvine estimated on pre-2020 data could have predicted that specific topology, because the protocols, the nodes, and the roads between them simply did not exist yet. You cannot map a highway that hasn't been built.
The limitations regarding deep tree estimation and unprecedented innovation are very real, I'll give you that, but they are entirely manageable through practical mathematical regularization.
Regularization?
Yes, institutional practitioners do not blindly follow the algorithm down into the noisy abyss of the 19th tree. They deliberately intervene. A standard, highly effective industry practice is to manually set all deep tree pair copulas, usually anything past the third or fourth tree, to strict Gaussian independence.
So you just force them to zero.
Exactly. We freely admit that the deep, nuanced structure is statistically unidentifiable from the available sample size of historical data. By forcing the deep edges to zero, we force the model to focus its computational power exclusively on the dominant, highly observable hubs and the primary branches of contagion.
It's a pragmatic cutoff.
Very pragmatic. The ultimate defense of the Vine-Copula framework is not that it maps reality perfectly, but that it works empirically in live, hostile market environments. We can look directly at the exhaustive 2023 study published by Saham Kadam and Stefan.
The dynamic optimization backtest.
Yes, they rigorously backtested dynamically optimized portfolios across a universe of 20 global assets, spanning equities, sovereign bonds, global commodities, and major currencies.
And they stress-tested it across multiple crises.
3 massive, structurally distinct systemic shocks: the 2008 global financial crisis, the 2011 European sovereign debt crisis, and the 2020 COVID-19 crash. Across all 3 distinct market regimes, the portfolios dynamically optimized using Vine copulas delivered between 15 and 25% lower realized tail risk compared to traditional Gaussian optimized alternatives.
That's a significant reduction in tail risk.
It is. During the March 2020 crash specifically, the portfolio managed by the Vine algorithm suffered a maximum drawdown of 18.3%. The Gaussian-optimized portfolio, relying on standard linear correlation, suffered a devastating drawdown of 26.7%.
That is an 8.4 percentage point differential.
And that 8.4 percentage point differential is not a statistical anomaly. And it is certainly not a rounding error. It is an 8.4 percentage point cushion of pure survival. It was generated entirely by superior tail dependence modeling and the accurate mathematical identification of those conditional firebreaks we discussed.
The firebreaks worked.
They worked. The map generated by the Vine algorithm might be an approximation and it might be inherently backward-looking, but it demonstrably protects capital when the hidden hub inevitably fails.
Well, an 8.4% survival cushion during a generational market panic is frankly a compelling empirical defense. It proves definitively that even a heuristic, mathematically truncated map of a star graph is vastly superior to a traditional correlation matrix that mathematically assumes the star graph doesn't exist at all.
Right.
I will grant you that the standard correlation matrix is essentially a blindfold disguised as a safety blanket.
That's beautifully put. As we synthesize our journey today, the paramount takeaway for anyone responsible for managing systemic risk, whether you are overseeing a complex global supply chain, optimizing a physical retail franchise network, or allocating capital within a multi-asset institutional portfolio, is that the diversified portfolio is a dangerous illusion if it is secretly functioning as a star graph.
Because relying on average linear correlation is demonstrably insufficient when dealing with extreme tail events where dependencies rapidly converge toward one.
Exactly. Vine copulas, despite their immense computational complexity, the necessity of heuristic search algorithms, and the inherent fragility of deep tree statistical estimation, provide the only robust topological stress test available in modern quantitative finance.
They are the only mathematical tool currently capable of finding the hidden root hubs, measuring the asymmetrical time lags with precision, and identifying the true directional arrows of systemic contagion.
And we return to our most critical shared insight of the discussion.
The contagion vine does not equal the recovery vine.
Right. The shock epicenter and the policy epicenter are rarely the exact same node within the network. The topology fundamentally rewires itself when the system flips from panic to rescue, substituting lower-tail Clayton black holes for upper-tail Gumbel hot air balloons.
The only question remaining for the listener
The individual responsible for allocating capital or managing network risk in the real world is whether they choose to look at their portfolio structural map before the traffic arrives or after the highway is completely jammed.
This is the research desk officially signing off.